What if I told you that with just $500,000, you could generate $28,460 every single year without ever touching your principal? That's $2,372 deposited into your account every month like clockwork. Sounds impossible in today's market, right? But here's the truth. While most retirees are scrambling with 4% bond yields and gambling on meme stocks, there are two dividend machines quietly building wealth for millions of smart investors. I'm talking about SCHD and JEPI, two ETFs that have a combined $110 billion in assets, and today I'm going to show you exactly why these are the only income funds you need for retirement. Let's face it, the retirement crisis is real. Social Security replaces maybe 40% of your income if you're lucky. Pensions, they're going extinct faster than dinosaurs. And bonds, sure, they're paying 4 to 5% right now. But with inflation eating your lunch, that's barely keeping you afloat. You need real income, growing income, and you need it without losing sleep over market crashes. That's where these two champions come in, and they couldn't be more different. First up, meet SCHD, the Schwab U.S. Dividend Equity ETF. This is the conservative warrior, the boring but brilliant choice that's been absolutely crushing it since 2011. We're talking about $69 billion in assets, making it one of the largest dividend ETFs on the planet. SCHD follows a simple but powerful philosophy. Own 103 of America's best dividend-paying companies, companies that have paid dividends for at least 10 consecutive years without interruption. These aren't fly-by-night operations. We're talking about Cisco, AbbVie, Amgen, Merck, Coca-Cola, PepsiCo. These are the companies you see every single day, the ones that print money regardless of what's happening in the economy. The genius of SCHD is in its simplicity. It charges you just 0.06% annually. That's $6 for every $10,000 you invest. To put that in perspective, that's less than your monthly coffee habit. And because it's passively managed, tracking the Dow Jones U.S. Dividend 100 Index, there's no portfolio manager making expensive bets with your money. The fund has a portfolio turnover of just 30%, meaning it's not constantly churning stocks and generating tax bills. It's a true buy and hold vehicle. Now let's talk about the yield. SCHD currently pays 3.92% based on its 30-day SEC yield. If you invest $10,000, you're looking at $392 annually, paid out quarterly. That's $98 every 3 months, deposited like a Swiss watch in March, June, September, and December. But here's where SCHD separates itself from everything else. This dividend grows. We're not talking about a static 3.92% forever. These are dividend aristocrats, companies with track records of increasing their dividends every single year. That $392 today could be $525 in 10 years and $700 in 20 years because of compound dividend growth. This is the retirement income that keeps pace with inflation while you sleep. Let's talk performance, because numbers don't lie. Over the past 10 years, SCHD has delivered 12.24% annualized returns. That's not just good, that's exceptional for a dividend fund. Even better, the 5-year return is 12.05% and the 3-year return is 11.27%. This fund has proven itself through multiple market cycles. Yes, 2025 has been slower with SCHD up only 2.8% year to date. But that's because value stocks took a breather while technology stocks soared. The beautiful part? Those quarterly dividends kept coming regardless. SCHD's portfolio tells you everything about its strategy. 19.34% is in energy companies like Chevron and ConocoPhillips. 18.5% is in consumer staples like Coca-Cola and PepsiCo. And 16.1% is in healthcare giants like Merck and AbbVie. This is your recession-proof armor. When markets panic, people still buy groceries, take their medications, and heat their homes. The top 10 holdings make up 40.9% of the portfolio, showing a concentrated bet on quality over quantity. Now let's talk about JEPI, the JP Morgan Equity Premium Income ETF. If SCHD is Batman, steady and reliable, Then JEPI is Iron Man, high-tech, and aggressive. Launched in May 2020, this fund exploded to $41 billion in assets by offering something revolutionary. 8.35% yield with monthly distributions. Yes, monthly. That's not a typo. JEPI pays you 12 times a year instead of 4, and that psychological difference is massive for retirees who want to see money hitting their accounts regularly. How does JEPI generate such an enormous yield? Here's where it gets interesting. JEPI owns 125 high-quality stocks including Nvidia, Microsoft, Amazon, Meta, and Alphabet. But here's the secret sauce. JEPI writes covered call options on the S&P 500 index. Think of it like this. Imagine you own a rental property. You're collecting rent every month, right? Now imagine you also sell insurance on that property and collect premiums. That's essentially what JEPI does. It owns the stocks and collects their dividends, but it also sells call options and collects premiums from those options. When the market goes up, JEPI captures most of the gains plus the option premium. When the market goes down, the option premium cushions the fall. The result is magical. JEPI currently yields 8.35% on a trailing 12-month basis. That means if you invest $10,000, you're receiving $835 annually, which breaks down to roughly $70 every single month. Let's look at the actual distributions. In October 2025, JEPI paid $0.361 per share. In September, it was $0.368. In June, there was a spike to $0.540. The monthly payments vary based on market conditions and option premiums, but over the past 12 months, they've averaged $0.396 per month, totaling $4.75 per share annually. Now, here's what shocked me about JEPI's performance. Despite paying this massive 8.35% yield, the fund is up 5.06% year-to-date in 2025. It's actually outperforming SCHD this year. The 3-year annualized return is 12.99%, which is higher than SCHD's 11.27%. How is this possible? The fund's 15.5% allocation to technology stocks caught the AI wave, while its options overlay captured premium income from market volatility. Even more impressive, JEPI has a beta of just 0.56, meaning it's half as volatile as the overall market. You're getting superior returns with smoother ride, but JEPI isn't perfect. The expense ratio is 0.35%, nearly 6 times higher than SCHD's 0.06%. That's the cost of active management and options trading. Also, those monthly distributions, they're taxed as short-term capital gains, not qualified dividends, which means worse tax treatment in taxable accounts. The portfolio turnover is 172%, meaning the fund trades aggressively. This is not a buy-and-hold index fund like SCHD. So which one should you choose? Here's where most people get it wrong. This isn't an either-or decision. SCHD and JEPI are designed to complement each other like Batman and Superman, different powers working toward the same goal. SCHD gives you growing dividends from the world's most stable companies with ultra-low fees and tax efficiency. JEPI gives you massive current income through option strategies while reducing your portfolio's volatility. Together, they create something powerful. Let me show you the ultimate strategy. Imagine you have $500,000 to invest for retirement. You allocate 60% to SCHD and 40% to JEPI. That's $300,000 in SCHD and $200,000 in JEPI. Your SCHD position at 3.92% yield generates $11,760 annually. Your JEPI position at 8.35% generates $16,700 annually. Combined, that's $28,460 every year, which equals $2,372 monthly. That's a 5.69% blended yield on your portfolio. But here's the beautiful part. You're not just getting income. You're getting diversified income from 2 completely different sources. SCHD's income comes from real corporate earnings and grows every year. JEPI's income comes from market volatility and options premiums, providing that extra boost. SCHD pays you quarterly for long-term planning. JEPI pays you monthly for immediate cash flow. SCHD has minimal taxes in taxable accounts. JEPI is perfect for IRAs where taxes don't matter. One fund protects you when value stocks outperform, the other protects you when growth stocks dominate. If you want maximum diversification, consider a 50-50 split. $300,000 in each fund gives you a 6.14% blended yield, generating $30,700 annually. That's $2,558 monthly with perfect balance between both strategies. Why does this work so well in 2025? Interest rates are falling, which makes dividend stocks more attractive as bond yields decline. There are trillions of dollars sitting in money market funds earning 4 to 5%, and as those yields drop, investors will hunt for alternatives. JEPI's 8.35% looks increasingly attractive. Meanwhile, SCHD's value stocks are positioned for recovery after technology's massive run. The AI boom is helping JEPI's tech holdings, while SCHD's energy and consumer staples provide stability. You're hedged for multiple scenarios. Let me be crystal clear. This is not financial advice. I'm not your financial advisor, but the data is undeniable. SCHD has a 14-year track record with 12.24% annualized returns. JEPI has a 5-year track record with 11.61% since inception. These aren't speculative penny stocks or crypto gambles. These are institutional-grade funds with $110 billion combined under management, backed by Schwab and JP Morgan. So here's my challenge to you. Calculate your actual retirement income need. Be honest about your expenses. Then work backwards using a 6% yield assumption. How much do you need to invest to hit your number? If you need $50,000 annually, that's roughly $833,000. If you need $40,000, that's $667,000. The math is simple once you have your target yield. And remember, with SCHD in the mix, that income grows every single year, giving you inflation protection that bonds can never provide. If you found this valuable, drop your questions in the comments. I read every single one, and I'll answer as many as I can. Hit that like button if you want more content breaking down real retirement strategies with actual data. And subscribe because next week I'm diving into tax optimization strategies for dividend investors that could save you thousands annually. Until then, remember, retirement income isn't about timing the market. It's about time in the market with the right dividend machines working for you. SCHD and JEPI are those machines, and now you know exactly how to use them.